The United States Treasury just announced a brand new borrowing plan, and it quietly turned the extra mortgage payments you've been sending into a $138,000 mistake. August 3rd, the official press release. The Treasury needs to borrow $739 billion this quarter. That's July, August, and September. That's $68 billion more than they asked for back in May. They need more, they said. And in the exact same breath, they casually mentioned, oh, by the way, next quarter we'll need another $628 billion. Cool? Cool. And if you take whatever extra cash you can scrape together every month, $100, maybe $500, and you hurl it at your mortgage, you're doing exactly what responsible people do. It's what your parents likely told you to do. And they weren't necessarily wrong until maybe now. You see, the Treasury's announcement just put a new price tag on that action. And I'll show you the math behind it, and whether it applies to you comes down to one single line item on your mortgage statement. Let's start with why the government needs $739 billion this quarter. It's pretty simple. Because of their old bills. That's why they need it. You see, this year, for the first time in American history, the interest on the national debt passed Medicare. Over $1 trillion a year, just interest. Not roads, not aircraft carriers, just interest. Meaning the government's fastest growing expense is the bill for its old bills. That's like taking out a payday loan to pay off the credit card you used to buy Crocs in 2019. The government doesn't have the cash flow to cover their bills. The net effect here is that the U.S. will go deeper into debt by $739 billion in what's called privately held net marketable debt. 5 words to avoid saying the 4 real ones. We need your money. And they'll get the money. They're going to get your money through Treasury notes, Treasury bills, tips, all that are privately held, like by individuals, banks, pension funds, and foreign investors and foreign governments even. So when you add up this quarter, plus the $628 billion they'll need next quarter, we'll go deeper into debt by $1.37 trillion in just 6 months. That'll be approximately $41 trillion of total debt by the end of the year. That's no bueno. And when you're that deep in the hole, there's no real clean way out of it. Do you raise taxes enough to cover it? No, you can't. That math, it just doesn't work. Can you cut spending enough? Well, nobody in Washington keeps their job doing that. And even without all the resistance that Trump's tariffs have received, they weren't making a dent in the deficit. They're certainly not going to default. That's not an option. And they can't afford a recession, for that would drive the government's revenues down even further. So they'll have to keep borrowing. You'll see another headline like this come first quarter of 2027. And we'll continue to see these borrowing announcements. And my prediction is, when there's nobody left to borrow from, the Fed will have to step in as the buyer of last resort and turn the money printer back on. That will obviously accelerate inflation. And wages, they're not going to keep up. Those holding assets are going to get richer, and those without are going to get poorer, continuing to increase the gap between the rich and the poor. So the debt doesn't get paid off. It never does. It gets shrunk, not the number, the real value of the number. See, prices are up about 30% since 2021, which means every dollar the government owes from back then is about 30% easier to pay back today. And then they didn't pay that down. Inflation did. In this cycle, it's going to continue. Now, I can't prove this part. It's just my prediction, because I don't think anybody with power is in a hurry to kill inflation, because slow, steady inflation is the only way out of the mess they built. And here's what that means for you and your mortgage. You see, your mortgage, it works the exact same way theirs does. The day you signed, your payment froze in carbonite like Han Solo. Since then, groceries went up, insurance went up, wages went up a little. Your payment never did, though. Every year, prices rise. The real weight of what you owe gets lighter. And you didn't lift a finger to make that happen. I mean, for once in your life, you and the United States Treasury are on the same side of a trade. You both owe money in a world where the purchasing power of that money keeps shrinking. But that's only half of it. Here's the half that can really cost you if you're not paying attention. Look at what the safe money is paying right now. A legitimately boring high-yield savings account or Treasury bills. I mean, it's north of 4% now. And it's all this government borrowing that's caused this. They're so desperate for that $739 billion, they have to bribe you to hand it over. So while your mortgage payment sits still, the safest investments, the safest ones, they rise. So as of this recording, those boring savings accounts are paying more than what 50% of all mortgages are charging. And if you don't know where to find one of those high-yield, safe, boring savings accounts, I posted my favorite 3 for my channel members at stackmybanks.com. You're welcome to check them out too. And I'll put the link below in the description for you. You'll see it right next to another link that leads to the current top 10 high-yield savings accounts in the market. So here's how this works. If your mortgage is at 3% right now, and you send in an extra payment of $500, you save 3%. That's a guaranteed return of 3%. If you instead chose to park that same $500 in one of those accounts, your $500 earns 4.5%. Guaranteed. Same money, same effort, but you get to choose what you get in return. 3% by sending it to your mortgage, or 4.5% parked in your bank account. There's a 1.5% difference in your return there. And there's not a right or wrong answer here. It just comes down to what you value most. A good night's sleep due to paying off your mortgage might be worth the 1.5% sacrifice in your return. That's perfectly okay. I get it. But as the government continues to borrow, as I predict, that gap is going to get wider and wider and wider. And the decision will be relevant to more and more people. And that decision on where to send that extra $500 will become more and more difficult, as you'll have to place a real value on being mortgage free. Like when the gap is 2.5%, or 3.5%, or 4.5%. Which one will you choose? Again, no right or wrong answer. It's up to you what you value most. Peace of mind, or real ROI, return on investment. But we're just talking about a single $500 payment here. What does that look like over time? Like the next 25 years on both sides? Well, let's compare. We'll assume there's a $300,000 balance left on your mortgage and your rate is 3%. Feel free to plug in your own numbers as we go along, but I'm going to use those as our example. Now, in scenario 1, we'll assume you make an additional $500 a month payment to the principal of your mortgage. You do that every month. And to keep this comparison apples to apples, when those extra payments kill the loan early, it'll be about 17 years in, we'll assume that you stay disciplined and send the whole freed up payment that you have now, plus the $500, straight into savings for the remaining years. In scenario 2, we're going to assume that you make your minimum mortgage payment, you make that every month, and then you send that $500 to your high yield savings account earning 4.5%. Run both paths for 25 years, and scenario 1 finishes $38,214 behind. Now, I told you this was a $138,000 mistake. We're getting there. But there's no crash here, no doomsday, yet no lofty expectations for the savings rate either. Just what they're paying today. That's the boring scenario. And even with the most boring scenario, the responsible act of paying down your mortgage costs you $38,000. It's not close. The zero risk scenario 2 beat your loan. Now, the question here is, did it beat it by enough for it to be worth it to you? Well, only you can answer that again. But notice, you didn't need the risk of the stock market to beat it. A plain old savings account outruns your mortgage today. Prepaying is donating, and the bank does not need your charity. Now, where does that extra $100,000 come from I was talking about? Well, same picture, same 25 years, same honest rules on both sides. Just swap the savings account for a plain old boring index fund at the market's historical average, 7%. Well, now scenario 1 finishes $138,000 behind. So $38,000, that's the floor and zero risk. $138,000, this is the historical average with market risk. Your number lands somewhere in between, wherever your comfort sits. And here's what most people don't consider. After 25 years, let's say you need some money to make the ends meet in retirement, because that $267,000 you saved in those final 8 years, it just didn't turn out to be enough. Or you had an emergency or something like that, but you need more money. Well, in scenario 1, you've got a paid off home. So now do you sell it? Do you refinance some money out, or do you reverse mortgage? Whatever you choose, you've got to go back in and get that money out. Kind of backwards to rush paying off a home if you're going to have to pull your money back out later anyway. And that's a very common game plan for people in their golden years. In scenario 2, you've got a paid off home here also, plus still $138,000 left, thanks to that index fund. So selling, refinancing, reverse mortgage, those are all still options. Those are all on the table, but they're not your only options.
Yeah, but what happens when rates finally fall and that savings yield dries up?
Simple. The day the yield drops below your rate, the math flips, and prepaying becomes the right move again. Here's the difference. The account can change plays any month you want. The extra payment can't. Once you send it, it's sent. I've been in real estate for 20 years, and in 20 years, I have never once watched a serious operator rush to pay off cheap fixed rate debt. Not once. They hold the cheap loan, and they keep the cash where they can reach it. Consider running your house the same way, like a business. Or not. It's up to you, and I'll cheer you on either way. All I want you to do is make an educated decision about this, as opposed to an impulsive one. So, 3 moves this week. Number 1, pull your mortgage statement and find the rate. If it's under 4%, this whole video was all about you. But if it's 6% or higher, carry on. You're good. But bookmark this video anyway. Because come next year, or maybe 5 years, whatever it may be, I think eventually it will be relevant for you. Number 2, lay out your options for where to send your extra payments. You may choose a high yield savings account, maybe the Treasury bills, maybe the index fund, maybe you've got some other low risk options above and beyond what I covered today. But lay them out so you can look at them all side by side. And then 3, decide. Which plan will it be for you? Extra cash to the mortgage or to a higher yield somewhere else? Now, I'm not your financial advisor. Your family, your life, your call. But the 2 plays in front of you are pretty clear. One of those plays costs you somewhere between $38,000 and $138,000. The other one doesn't. And if you learned something today and would like more analysis and strategy discussions like this, consider becoming a member of the channel. You'll see the join link down below where I release members-only videos. You'll have access to those, including the monthly home defense briefing, and starting this month, all videos ad-free. Or do nothing and just hit the subscribe button for regular epic programming. And look, one thing we do know right now, refinancing is off the table. It's dead, really. And that's why I pulled this one out here for you to watch next, because there's another move smart homeowners are quietly making right now to lower their mortgage payment without messing with their interest rate or their mortgage term. If you could use some relief in your monthly cash flow, you'll probably want to watch this one here right now. All right? Run your house like a business. Defend it like your home. God loves you, and so do I. Take care.